All right, the December 15th advanced tax deadline is right around the corner, and there's one really common habit that could end up costing you a whole lot of money. So, in the next few minutes, we're going to break down exactly what to avoid so you can handle this whole thing smoothly. Let's dive right in. There's a reason we're kicking things off with this quote. It's just such a powerful truth. When it comes to taxes, putting things off isn't just a bad habit, it's a financial liability. Pushing this task down the road can lead to some very real penalties, and that's exactly what we're here to help you sidestep. And here it is, the reason for the urgency. December 15th. This is the due date for the third installment of advanced tax. It's an absolutely critical deadline, and it doesn't matter if you're salaried, a freelancer, or running a business in India. This applies to you. Okay, so to make sure you're ready, let's just walk through some of the most common and totally avoidable pitfalls in advanced tax. Think of this as your roadmap to getting it right this year. First up, we've got a classic oversight, completely forgetting about income that doesn't show up in your bank account every single month. It's so easy to just focus on your regular salary or your usual business revenue and let these other one-off payments slip right through the cracks. Yeah, we're talking about things like your yearly bonus, any capital gains from selling stocks or mutual funds, or maybe some salary arrears you received from a pay hike. All of this, every single bit, counts towards your total income and absolutely has to be factored into your tax calculation. All right, the next couple of mistakes are all about choosing guesswork over actually checking the facts. This is where a tiny little estimation now can lead to a huge tax shortfall later on, and it all boils down to making some pretty faulty assumptions. So this pops up in two common ways. First, just assuming you're eligible for a deduction without actually checking the latest rules. And second, for all you business owners, it's using wishful thinking instead of a realistic projection for your income. The bottom line, you have to base your calculations on facts, not hopes. Now this next mistake, it's a big one. It's when the tax you think has been deducted from your income, what's in your records, doesn't match what the government's records show. Believe me, this kind of mismatch can cause some major headaches down the line. So what's your best defense here? You have got to regularly check your Form 26AS and your Annual Information Statement, or AIS. Think of those as the government's official scorecard. You have to make sure your numbers match theirs. It's the only way to be sure you're claiming the correct amount of tax that you've already paid. Okay, let's look at a few of those technical rules that are just so easy to miss. Getting these small details wrong can actually have a pretty big impact on your final tax bill. For instance, are you using a presumptive taxation scheme? Well, you have to apply it correctly. For companies and high-income folks, you might need to think about things like minimum alternate tax, or MAT, and alternate minimum tax, or AMT. And finally, always double-check which expenses you're not allowed to deduct. This next one, it trips up so many business owners. Did you know there are two completely different sets of rules for calculating depreciation on your assets? That's right. There's one way for your company's accounting books and a totally different way for your tax calculations. And this is exactly why you just can't copy the depreciation number from your company's books. For your tax return, you absolutely must recalculate it using the very specific methods and rates that are laid out in the Income Tax Act. No shortcuts here. And the last common error is giving in to that temptation for a shortcut. Just copy-pasting last year's tax calculation might seem super efficient, but think about it. Your income, your deductions, even the tax laws themselves can change from one year to the next. It's a total recipe for mistakes. So, we've gone through the common mistakes, but what actually happens if you make them, or if you just miss the deadline altogether? Well, the consequences are financial, and they are automatic. Here is the magic number you really need to remember: 75%. By December 15th, the Income Tax Department expects that you have paid at least 75% of your total estimated tax for the entire financial year. That is the benchmark you have to hit. And if you fall short of that 75% mark, interest penalties kick in automatically. These are levied under Sections 234B and 234C of the Income Tax Act, and trust me, they can add up surprisingly fast. But hey, let's not end on the scary stuff. Instead of seeing this as some kind of chore, there's a much more powerful way to approach advanced tax. Let's call it having a smart tax mindset. This right here is the key takeaway from this entire explainer. Advanced tax is not extra tax. You're simply paying the tax you already owe, just in installments. This is fantastic for managing your cash flow,
it helps you avoid a massive bill at the end of the year, and it keeps you compliant. Honestly, it's just smart financial planning.
So we'll leave you with this one crucial question. Is your tax plan ready for December 15th? Now that you know the common traps to avoid and the right way to think about it, just take a few minutes to review your numbers. Getting it right now will save you a ton of time, money, and stress later on. Thanks for tuning in.